There's been a lot of noise around JP Morgan Chase topping earnings estimates this quarter, and on the surface it looks like a clean, powerful win. The bank delivered roughly $16.5 billion in net income, earnings per share near $6, and revenue just under $50 billion, well ahead of what analysts were expecting, but stopping at the headline misses the real story. The biggest driver of that outperformance was the markets division, where trading activity surged as volatility returned across asset classes. Fixed income desks were especially strong, supported by macro uncertainty, rate swings, and repositioning flows, while equities trading also contributed meaningfully. This kind of environment plays directly into the strengths of the largest Wall Street franchises, and JP Morgan executed exceptionally well. At the same time, investment banking fees rose sharply, signaling that deal-making activity, while not booming, is clearly alive. So this wasn't just a one-engine quarter. Multiple segments fired together, but here's the nuance. A strong trading quarter proves capability, not consistency. Volatility can supercharge earnings temporarily, and while that highlights competitive advantage, it doesn't guarantee the same level of performance every quarter going forward. When you look deeper, the core banking engine was just as important, even if it got less attention. Net interest income came in around $25.5 billion, supported by massive loan and deposit balances, roughly $1.5 trillion in loans and $2.5 trillion in deposits. That tells you this is still a dominant lending and deposit franchise, not just a trading house riding market's wings. Consumer activity remained resilient as well, with continued spending, new account growth, and rising client assets. On the wealth and asset management side, inflows and assets under management increased, adding a more stable layer of revenue. Meanwhile, the payments business continued to grow quietly in the background, reinforcing how deeply embedded the bank is in global financial flows. All of this paints a picture of breadth, not fragility. However, higher expenses driven by compensation, hiring, and operational costs remind you that maintaining this scale isn't cheap. Credit metrics were stable, not deteriorating, but not risk-free either. So while the quarter showed strength across multiple layers, it also showed that the machine requires constant input and discipline to keep running at this level. What really shaped the market's reaction, though, wasn't the numbers, it was the tone. Leadership, including CEO Jamie Dimon, made it clear that while the present looks strong, the future is far from certain. They highlighted geopolitical tensions, elevated asset valuations, persistent inflation concerns, and large fiscal deficits as ongoing risks. This is consistent with the broader messaging the bank has been delivering. The economy is holding up, but the system is not free of pressure points. That dual message, strength today, caution tomorrow, is why the stock didn't simply surge after the release. Investors are trying to separate what's repeatable from what's situational. A volatility-driven trading boost, for example, may not persist if markets calm down. Similarly, investment banking momentum can stall if uncertainty causes companies to delay deals. Add to that the fact that JP Morgan is already viewed as a best-in-class operator, expectations are naturally higher. A simple beat isn't enough to shock the market anymore, it needs to shift the forward outlook in a meaningful way. So when you step back, the cleanest interpretation is this. JP Morgan didn't just beat expectations, it demonstrated how powerful a diversified financial machine can be in a complex environment. Bank showed strength in trading, improvement in investment banking, stability in core lending, growth in consumer and wealth segments, and exceptional capital strength with hundreds of billions in reserves and liquidity. That's not a narrow win, that's structural strength, but at the same time, management refused to declare victory over the macro environment, and that restraint matters. This wasn't a signal that risks are gone. It was a reminder that strong institutions can perform even when risks are rising. So the quarter was very strong, but not a green light to ignore uncertainty. The real takeaway isn't just that JP Morgan made a lot of money, it's that it did so across multiple engines while still preparing for a more complicated road ahead.